video, I'm going to talk to you about the NFMW investments and give you a bit of an investment update as well as a return update. We are also going to try and answer some frequently asked questions. For example, members often want to know how are their monthly retirement contributions invested and who decides how the savings are invested. You will recall that every member has got an investment choice. That means they can choose, or members can choose, the individual investment portfolios that their contributions and fund credit will be invested in. There are 5 individual investment choice portfolios: Capital Protector, Stable Growth, Capital Growth, Aggressive Growth, and Sharia portfolios. Should a member be uncomfortable to select any of these investment choice portfolios, they can also choose the Life Stages default model. This model is then an automatic model where members' fund credits and contributions move from a more aggressive investment portfolio to a less aggressive investment portfolio as they age and get closer to their retirement. We have recently got quite a lot of questions with regards to negative returns and why there are periods where the fund experiences negative returns. And then, of course, what can be done and when will the returns actually get better? One must realize that returns are basically linked to the underlying investments or asset classes that the fund makes use of to invest all the member contributions. These investments are exposed to local economic and geopolitical factors, as well as global economic and geopolitical factors. Higher returns are directly linked to taking on more risk to achieve those returns. Therefore, investing into asset classes that will achieve a higher return naturally will also increase your risk. One measure or one risk measure is volatility. Just means that market volatility or price movements can vary significantly when you invest in an asset like, for example, equities. The investment horizon of your investment is of utmost importance, because if you do have a long-term investment horizon, volatility may become less important, whereas if you have a short-term investment horizon, you do not necessarily want to experience volatility. Therefore, for younger members, they can take on more risk and more volatility as they will have a longer time horizon to invest their funds and build up a sufficient fund credit. For those members closer to retirement, you would probably want to protect your fund credit and not be invested in high volatility investments. The portfolio suitable for this would be your stable growth and your capital growth portfolios. One needs to note that South Africa is not functioning in isolation. Therefore, South Africa is also exposed to what happens in the global economic environment. Of late, the trade war between the US and China, United Kingdom leaving the Eurozone, the global growth slowdown, and all other geopolitical issues have created uncertainty and lowered the confidence levels of investors all across the world. Just basically means that we have experienced a period where your high risk type assets like equities underperformed the lower risk investments like cash or bonds. We don't know exactly when this will change again, but we do know that over the long term, the aggressive growth and capital growth portfolios should again outperform the lower risk portfolios like the stable growth and capital protector portfolios. So, what does the fund do to try and minimize any negative impact on returns for members? The answer to this is basically diversification. It boils down to the old saying, don't put all your eggs in one basket. The principle basically is just to say that one asset class or investment will perform differently from another asset class or investment under different economic scenarios and conditions. For example, should interest rates decrease or go down, it may be very good for local equities, but not so good for global equities or offshore investments. Therefore, if you have both those asset classes in a portfolio, on average, you will still experience good returns, and you will not be exposed to one single factor that could affect your portfolio in a severe way. The fund employs diversification on various levels. For example, it invests in different asset classes like equity, bonds, cash, property, and offshore assets. Also, different geographical allocations. For example, quite a lot of the assets will be invested in South Africa, but also up to about 30% of the investments could be invested in non-South African assets or offshore assets. There's also the fact that we make use of various asset managers to diversify the risk away from one single asset manager. We often get asked whether members should switch to safer portfolios that provides guaranteed positive returns, like the Capital Protector portfolio. The Capital Protector portfolio is invested 100% in cash and therefore will provide a positive return on a monthly basis. However, it needs to be noted that over the long term, we know that equities will outperform cash by between 5 and 7%. This we know will happen again, although we have recently experienced a period where this has not been the case. If you want to make a switch into a safer portfolio, please always speak to a financial advisor that will consider your financial needs and your specific circumstances before making that choice. To time the market and to time a switch into a different portfolio is very difficult for investors and members to make. If you were planning early retirement, but things are not going the way you would like, what options do you have? This is a very difficult question because there's not much anyone can do to make sure you can retire early. The only answer to this question really is to save more and start to save earlier. You can do that through additional voluntary contributions, for example, into the NFMW portfolios. The only other alternative is then to work for longer and make sure that you build up enough cash to one day retire with a decent pension. I think it is worth to point out that the biggest buildup in your fund credit actually happens over the last 10 years of employment, purely because the effect of compound interest creates a scenario where your fund credit grows substantially over the last couple of years before your retirement. How do we measure whether you will one day be able to retire comfortably? Normally what we do is we use a net replacement ratio. A net replacement ratio is purely looking at your pension that you will receive after tax and compare that to the salary that you receive just before retirement, also after tax. If you divide your pension with your salary at retirement, you will find a ratio, and that we call the net replacement ratio. Industry norms are normally dictating that this ratio should be around 70% to maintain your working or your living standard after retirement. This is also generally the ratio you should aim for if you want to retire at any point in time. Let's have a look at fund performance. The first thing to note is that we do compare your fund returns to other funds, other local government funds. We often get asked by members to actually compare their fund returns to their colleagues' returns that's experienced by their colleagues. And this sometimes creates inconsistencies, or you sometimes compare returns that is not on a like-for-like basis. There are many factors that influence or can influence the return on your funds and on your fund credits. And this needs to be exactly the same if you want to make those comparisons. If you compare your fund returns to that of a colleague, be very careful not to make certain assumptions and get to the conclusion that your fund has actually underperformed your colleague's fund. Factors that can influence these returns could be years of service, your salary that's been received throughout your working life or for the period that you are comparing it against, your net contribution rates, transfer from other funds, portfolios and investment choices over many years, additional voluntary contributions, divorce settlements, direct home loans, and other factors like surplus distributions. It is therefore not wise to compare your benefit statement to a colleague which belongs to a different fund. However, what we can do is we can compare the NFMW fund returns to local government peers and make sure that the fund actually performs on par with other funds in the industry and throughout industry. I would like to draw your attention to this slide and just note that the NFMW Aggressive Growth Portfolio, for example, has outperformed all other local government funds, or one of the major ones that can be considered their competitors over the last 5 years, 7 years, and 10 years, and also over the last 1 year. Very good performances also coming from the Capital Growth Portfolio and the Stable Growth Portfolio. Moving on to the individual portfolio performances, Sharia Capital Protector, Stable Growth, Capital Growth, and Aggressive Growth portfolios. This slide gives you the performances of these portfolios over various periods. I would just like to draw your attention to the 5-year annualized return column, which just shows that all the portfolios have basically returned around 7.5% to 8% over that 5 years. Inflation for that period has been running at around 5%. Just goes to show that we have experienced a 5-year period where risky type assets like equities have not really outperformed the lower risky type assets like cash and bonds. We do know that this will again change in the future. Moving on to the latest investment performance, you can see the year-to-date performance up to the end of October has been excellent. The Aggressive Growth Portfolio returning 10.75%, Capital Growth 9.93%, Stable Growth 6.47%, and the Capital Protector 6.74%. Members are encouraged to always consult with a qualified financial advisor when making important decisions regarding retirement savings. A qualified financial advisor will take account of your specific needs and your circumstances and will be able to provide you with advice, even if you want to switch portfolios, for example. Please subscribe to receive our monthly updates via email or by visiting our website at www.nationalfund.co.za, and we will gladly add you to our mailing list. If you want to contact us for any other reason, please do so with any of the links that's shown below on this slide. Thank you very much for listening to us